Hi, this is Gleason. Welcome to Chapter 1 on Bookkeeping and Accounting. This chapter has 14 topics. Each topic has its own separate presentation or video. We have completed the first three topics, that is, the definition and process of accounting, the difference between bookkeeping and accounting, and the objectives and benefits of accounting. We are now on topic 4. This topic covers the accounting principles, also known as concepts and conventions, upon which the subject of accounting is based. Let's start with an understanding of the terms principles, concepts, and conventions. Principles are a set of guidelines or rules or beliefs or values or ethics that a person usually follows. We have heard the famous phrase, he's a man of principles. It means that a person strictly follows the principles and does not deviate or turn away from them. Similarly, accounting also has certain principles that have to be followed in order to maintain uniformity in accounting. These accounting rules or guidelines have been devised by humans and have been used over time to different situations. Since these principles have been found to be good, they have gained general acceptance and universal recognition and can be used in every country of the world. Due to its general acceptance and universal recognition, it has its own abbreviation GAAP, which is Generally Accepted Accounting Principles, also known as GAAP. But what exactly are these accounting principles? These are the assumptions and common practices that have been followed and used in accounting and have gained popularity and worldwide acceptance. They are also known as accounting concepts and conventions. These principles are the foundation upon which the structure of modern accounting practice is based. There are 13 such principles, and we will look at each of them in detail. Let's start with the first concept, going concern concept. This concept assumes that a businessman or woman opens the business with the intention of continuing the business year after year. A person does not open a business to shut it down in the following week or month or year. The person's intention of starting even a small business is to continue the business for many years to come and to make it grow and prosper. There is absolutely no intention of closing down the business. We are discussing about opening a business and not undertaking a project or a joint venture. The business may, once opened, undertake projects or joint ventures. We are now only at the conceptual stage of opening a business, and once opened, the business is intended to carry on operations continuously, forever, on an ongoing basis, year after year. The second concept is the consistency concept. As you study the subject of accounting, you will understand that there are certain practices or methods that should be followed religiously. The same practices or methods should be followed for all subsequent transactions of the same nature, consistently, year after year, and should not be changed just for the sake of changing it as per our wish. There are certain permitted reasons only for which the practices can be changed. These are to comply with accounting standards. This could be a case where a small business grows and now needs to adhere to sound accounting practices. Also, they could have previously maintained a single entry system of bookkeeping and now, due to their growing business needs, are required to maintain a double entry system of bookkeeping to record their transactions properly. The second reason is that if there is a change in accounting standard, accounting standards and practices have evolved over time. The tax authorities of a country may require either a change in practice or additional practices to be in place to disclose certain additional or detailed information. In such cases, the practices can be changed to comply with the new form of reporting to the concerned authorities. The third reason for a change in accounting practices is if the law of the land requires you to do so. A case for this reason could be frauds that come to light with other businesses. These frauds are normally the result of certain loopholes in the practice or system. The government may come up with certain legislations or laws to plug the loopholes in order to ensure that certain frauds do not occur again. In order to adhere with these new laws or legislations, we may have to change our accounting practice. The fourth reason for change in accounting practice is if the business feels that they need to represent their business statements in a better manner and disclose more details. This could attract investment in the business. However, in order to adhere to the concept of consistency, this reason for change should be followed only in case of major changes and should not be used as an excuse to change practices every year. The third concept is money measurement concept. We have seen in the first topic of the definition of accounting that the entire accounting process is all about dealing of financial transactions in terms of money. Money plays a very important role in accounts. Everything is done in terms of money. Money is the only unit of measurement used in accounting. Everything else is just extra information. Qualities of a person, such as intelligence, honesty, integrity, etc. Physical characteristics of a person or an object, its attributes or features, weight, height, age, number of items, etc., are all irrelevant in accounting. The only unit of measurement that matters and that should be recorded is the monetary value of the financial transaction. That's it. The fourth concept is the revenue recognition concept. This is also referred to as the realization or accrual concept. According to this concept, any revenue or income that you earn from your business should be recognized and recorded in the period in which the transaction takes place or in which it is earned or realized, irrespective of the fact whether money has been received or not. In simple words, it means that we need to recognize and record the sales or income whenever the transaction takes place and not when we receive the money for it. Receiving money is termed as settlement of the transaction. So we need to recognize our revenue at the time of the transaction and not at the time of settlement. If the transaction and settlement happen together or in the same accounting period, even then the date of the transaction will be the date of the accounting entry. The reason behind this concept is that as soon as the transaction takes place, we have got a right to receive the money, and since we have received this right, we should record it. Let us take a couple of examples to understand this concept. If, for example, in the final quarter of a financial year, we make a credit sales, which means that we have sold some items but have not yet received the money for it. Since we know the other party, we have given them 4 months to pay for it. In this case, the transaction of sales has occurred in the financial year 1. However, the money for the transaction will be received or settlement will happen in financial year 2. In this case, whether we have received the money or not, since we have sold the items in the financial year 1, we need to record the transaction and recognize the revenue in financial year 1 on the date of the sales transaction. We have accrued or we have realized that we have the right to recover the compensation for the items sold from the other party. Let's look at another example. This is the project contract for the construction of a bridge. The terms of the contract state that the contractor has agreed to construct the bridge within 3 years and 3 months. The terms of the payment are that the contractor will receive an initial advance and the remaining payments on completion of 30%, 60%, and 100% of the project work. We are working in the accounts department of the contractor. Whenever we receive any money, we should record it since it's a financial transaction. So we should record the initial advance received. Now we are not supposed to receive any payment for the completed work or project sales during this financial year, that is year 1. However, we have completed a significant portion of work. Let's say we have completed 20% prior to the year end. So what should we record as our project sales for the year? Since we have completed 20% of the work, we have the right to claim 20% compensation, and our project sales for the year should be 20% of the project value. The advance received can be adjusted against this 20% sales. If the advance is insufficient to cover the entire 20% project value, the difference can be treated as a credit project sale, which is similar to the first example. Based on the accounting practice of the organization, the 20% project sale can be recorded either annually or monthly or quarterly based on the accounting practice followed. In case of a monthly accrual practice, the percentage of work completed per month would be the project sales value. Likewise, in each year, we can recognize that proportion of the project that is completed in that financial year, irrespective of the fact whether we have received money for the completed work or not. So in this revenue recognition or realization or accrual concept, we need to recognize and record the revenue whenever we have the right to recover compensation, whenever the transaction takes place and not at the time of settlement. Similarly, in case we purchase on credit, the other party who sells to us gets the right to recover compensation from us, and hence we need to record the purchases on the date of the transaction and not on the date of payment. We now move on to the accounting conventions. These are the practices or traditional approaches that have been practiced and are generally accepted as a valid accounting principle. We start with the business entity principle. This is also known as the accounting entity principle. As per this principle, the owner and the business are two separate entities. They are different from each other and should be kept separate. Even their transactions or dealings should not be mixed with each other. Let's understand this convention in detail with examples. When a person starts a business, he either invests money or both money and property to start the business. For example, if the owner rents a place to start the business, he has paid the deposit to the landlord. After that, he may renovate the premise, for which he may buy certain furniture himself or engages either a carpenter or an interior decorator to furnish his premise. He has to pay for this expenditure to set up his business. Additionally, he may buy certain machines, computers, air conditioner, etc. to set up his business premise. Once the premise has been set up, if he deals in certain things, he may order them in order to resell them and make profits. On the other hand, if he makes and sells or manufactures and sells, he may have to buy the raw material prior to starting the manufacturing process. Setting up a business takes time and money. The owner invests his money to set up the business. In other words, he pays money for the business and on behalf of the business. Whatever amount the owner spends for the business is the owner's contribution. The business is supposed to give it back to the owner along with all the profits and losses incurred by the business. The accountant or the bookkeeper is also employed for the business and not for the owner's personal residence. So, whenever we record any transaction with the owner, we need to record it from the business angle or business perspective since we work for the business. Even if the owner takes money from the business, it should be recorded as a business transaction. Also, whatever the owner buys for the business belongs to the business. The business furniture and the air conditioner belongs to the business since he has purchased it for the business. Again, all business expenses should be recorded. For example, the rent of the premise, the gas, water, and electricity charges, staff salaries, etc., should be recorded as business expenses since they are incurred to run the business. If the business didn't exist, these expenses would not have been incurred. On the other hand, any personal expenses of the owner, such as his residence gas, water, and electricity charges, his food and entertainment expenses, etc., should not be recorded in the books of accounts, since they belong to the owner and not to the business. The next accounting convention is the accounting period or periodicity principle. In the going concern principle, we have learned that a business is set up for life. There is no intention of closing it down. The intention is to carry on the business year after year. If that is the case, when do we measure the success of the business? We cannot just wait till the end of the entire lifetime of the business to finally measure its success or failure. We need to measure its performance on an ongoing basis. Also, there needs to be a common yardstick of time in which we can measure the business performance. We cannot randomly decide to measure the performance after 2 months, then in the 8th month, and later again in the 15th month. The yardstick should be used consistently. It should adhere to the accounting principle of consistency. That common yardstick of time in which we measure the business performance is known as an accounting period. Accounting period is usually a 1 year period and is generally known as a financial year. The financial year may differ from a calendar year. In some countries, the financial year is the same as a calendar year, while in others, it may start in April and in March, or start in July and end in June. However, large companies do break down the accounting period into quarterly periods and come out with quarterly results at the end of it. However, from a financial and statutory compliance perspective, the financial year period is universally recognized. The books of accounts are maintained for a financial year, after which the books are closed and the results calculated to measure the business performance. With a new financial year comes new set of books, new targets and new records. This is similar to children's studies. They perform throughout the year, get their results, and at the end of the year, the parents evaluate their performance and move ahead to the next year with a new set of books and new targets for the new year. The next accounting convention is the historic cost principle. As per this principle, all business owned things or assets are to be recorded at their historic cost price or purchase price. The actual cost incurred to purchase the asset as on the date of purchase should be recorded in the books of accounts. The current market value of the asset should neither be reflected in the books of accounts nor should the asset be adjusted to reflect the current market value. The next accounting convention is the objectivity principle, also known as verifiable objective evidence. This principle requires every accounting transaction to be supported by evidence of that transaction, which should be verifiable. We cannot record anything that we remember if we do not have any evidence for it. The evidence required is documentary evidence such as bills, receipts, vouchers, delivery notes, contracts, etc. These documents should be preserved and filed sequentially in the order in which the transactions occur. If the auditors or any authority would like to verify the sanctity of the transactions, they can easily refer to the documentary evidence supporting the transactions. The documents are a proof of the transactions having actually occurred and are accepted as evidence in the court of law. This principle ensures that businesses are truthful and record transactions that have actually taken place. The next accounting convention is the matching principle. This principle requires that all expenses incurred must be recognized in the same accounting period in which its related revenues are earned. In other words, if the revenue is recognized or realized in an accounting period, all the related costs or expenses incurred towards earning that revenue should also be recognized and matched against that revenue in the same accounting period. For example, if a car dealer sells cars and pays commission to the car salesman for each sale, for the total revenue earned by the dealer in an accounting period from the sale of cars, the related commission paid to the salesman should also be recorded as a cost in the same accounting period. Another example for the same is the bridge construction example of the revenue recognition principle, where all related expenses should be recorded for the revenue to be recognized, as the revenue is directly related to the proportion of work completed and cost incurred. The next accounting convention is the dual aspect principle. This principle is based on the principles of double entry bookkeeping that every transaction has two aspects which are equal and opposite in nature. One has a debit effect and the other a credit effect. Since they are equal, debit will always be equal to credit. Any change in one aspect is accompanied by an equal and opposite change in the other aspect. So at any given point of time, the sum of all debits will always be equal to the sum of all credits. We will learn this aspect in detail with examples from topic 6 onwards, that is double entry bookkeeping. The next accounting convention is the conservatism principle. This is also known as the principle of prudence. Prudence means caution. We have to exercise caution in accounting. We should be conservative or old-fashioned or traditional in our accounting practice. We should not be overexcited and overestimate the revenues. Rather, we should be alert and only record the revenues or income when they are realized or accrued at the lowest possible value. Future sales or expected gains or future income should not be recorded. For example, if we have some unsold items, they are our stock and have value. They can be sold in the next accounting period to earn revenue for the business. When we close the books, we should record their value at cost price or market price, whichever is lower, in line with the principle of conservatism of recording the lowest possible value for revenue. At the same time, all probable losses or expenses that may arise in the future should be recorded as soon as they are discovered. We need to be cautious against anything that can bring down our business or cause a loss. We need to provide for the probable losses by creating a provision for doubtful debts. This provision helps us to gain tax concession as it is permitted to be recorded as a loss in the financial statement. The principle of conservatism or prudence is based upon the view anticipate no profit but provide for all probable losses. This implies that all revenues are to be recorded at the lowest possible value, while all expenses and losses should be recorded at the highest probable value. This principle benefits us as it helps us to avoid the shock of unexpected losses while allows us to enjoy the unexpected gains. This is similar to the condition of a student after the exams. When the parents ask about his performance, if he mentions that it was very good, but his results show poor performance, both he and his parents will be disappointed. On the other hand, if he mentions that he feels he may have made some mistakes and expects an average result, however, if the results are good, he will definitely be happier. The next accounting convention is the materiality principle. This principle states that tiny items of cost which are of insignificant material value to the business and which will not mislead the business results need not be given strict accounting treatment as per the usual accounting practice. For example, when the organization orders stationery for its business use and as few items of pens, pencils, etc. are still left, they need not be recorded as items that can be sold and have value. Rather, the entire amount of stationery purchased can be shown as an expense in the period in which it was purchased. Materiality is subjective. Where should we draw the line between material and immaterial value is a matter of judgment and common sense. For an industrialist, $500 would be insignificant or immaterial. But for a small grocery shop owner, $500 will have a material impact and should be recorded. For the grocery shop, maybe $5 to $10 would be immaterial. It's up to the accountant's discretion and common sense to give the right treatment. The next accounting convention is the full disclosure principle. This principle is the opposite of the materiality principle. It requires that all significant information that will impact the business results as well as its future performance should be disclosed in either the financial statements or the annual report. Whether something should be disclosed or not will depend on whether it is material or not. For example, loans taken by the business should be disclosed along with the lender and the rate of interest. Any probable losses anticipated or any amount that may be payable by the business in future, such as for settlement of a court case, having material value should be disclosed. Similarly, in case of valuation of assets, the method of valuation should be disclosed. This brings us to the end of this topic. In this topic, we have learned the various accounting principles which are based on certain assumptions and practices followed. In the next topic, that is topic 5, we will have a look at some important terms covered in the remainder of this chapter. If you have found this video interesting and would like to learn bookkeeping and accounting, please do subscribe to my channel and click the bell icon to get notified whenever a new topic or chapter gets uploaded. The entire list of chapters, topics, and related video links are in the description section just below the video. Click on the Show More button to view the complete list. Please click on the like button below and leave your comments as well. You can also share the videos by clicking the share button with your colleagues and relatives so that they too can benefit from this series. Thank you and stay connected.